Hi, let us talk about a cash conversion cycle model. Um, why it is important for you to understand the cash conversion cycle. Now think of this. How many days your money is stuck into the operation? This is exactly a cash conversion cycle in days. And that is, it's coming from where? It's coming from understanding what is the days sales outstanding in your uh, in your business or a company. How many days are you allowing inventory staying in your store? And how many days payable? I mean, the supplier, they allow you until you pay them. So a cycle, it's you take a DSO, which is a days sales outstanding, you plus with the DIO, which is inventory outstanding in days, and you minus the payable, which is a DPO, which is a days payable outstanding. And what you are getting what? The cash conversion cycles in days. And if you look here, it shows exactly that, which it gives you a DSO plus a DIO minus a DPO in days. Okay. So you need to understand that once you understand a cash conversion cycle, how does it work? And you know that the less days you have in that, it is more efficient in your business. Why? Because that money is tied up in your business. Okay. Just imagine like the investment. Okay, you have bought material. Okay, and on credit, and then you allow uh, to be in the inventory. Of course, they are there until you start, your operation, whether you are in retail, you sell straight, or you are in manufacturing, it needs to go another steps before it becomes sales, right? And so once you sell, even your money is tied up with the customers, right? Until they pay, then that is the time that you have a cash in your bank. So let's say, for example, in here, it say that it takes 35 days. What does it mean? It means your money is tied up in your operation for 35 days until you get it in your bank account. It means when you take it in revenue, understanding those 35 days, okay, how much money or investment is lying in that, is tied up in that cycle. It is 9,500, okay, US dollars, whatever the currency you're giving. So, um, what is the formula that it shows a CCC in a revenue? Okay, it means what you're taking a revenue itself from the income statement, you divide by a whole year, of course, it's 365 days, and then you times with a CCC days, which is 35 days. So it tells you that amount of money, the portion that is lying within the 35 days out of 100,000 revenue a whole year in 35 days. The money which is lying in your uh, working capital is 9,500, and you can see what is the percentage of that as well if you want, right? So it's very important that you need to understand how CCC model is built up, okay? And then you need also to understand that you need a history. First, if your business is already in the market, of course, you'll have a history. So you need, why before I show you that you need, if we go back, we need a statement, three financial statement, because it will show you the history. Then that is the only way that you can come out and do your a projection of a CCC based on the history. Thank you very much. I'm going to stop here until another module. See you later. Thank you.